Hello, I'm Robert Smith, the Digital Content Director for the Embark online community, and we're back with Matt Coakley, a certified financial planner from Summerville, South Carolina. Matt is with Waypoint Strategic Advisors, and today we're going to be talking about life and disability insurance and the importance of it. Matt, which one is more important, disability or life insurance?
So that's a really good question. What my dad would say is, it depends. If you know you're going to get disabled, if you know you're going to die, the answer becomes really easy. But one thing I think a lot of people think about life insurance, which is really important, and kind of skip over the disability insurance. But until we reach a certain age, we're much more likely to become disabled than we are to die. So it's not something that I definitely would think about glossing over as something that you don't need. So I would say they're equally important. Younger people are more likely to become disabled than pass away, but I think you need to have a combination of the two, or at least have considered a combination of the two.
How would I go about getting disability insurance? Does an employer offer it, or what if I have an employer who doesn't offer it?
Sure. So it can be. Our company, we have a long-term disability insurance policy for all of our employees, and it's through the employer side. For any employers out there that want to look at it, it's fairly inexpensive. It's a good way to get insurance and add an extra benefit onto your people. So if you have that option, that's a good thing to look at. One thing I caution people with insurance that comes from your employer is if you ever change jobs, then that insurance is gone. So you can buy it through any insurance agent that has a life accident and health license, which is going to be most of your people around will do that. So a couple things on the disability insurance side. You want to pay attention to what the insurance policy's definition of disability is. So there's something called own occupation that I really recommend is in any disability insurance contract. And what that says is if I can't do my job, then I'm disabled. If it doesn't say that, then it usually defaults to any occupation. And what that means is if you can't do any job, then you're technically disabled. I'll give you an example. I used to live next door to a doctor. She was a surgeon, and she had hand issues. So obviously you can't be a surgeon if you have hand issues. So her disability insurance policy kicked in and started paying her because it said if she can't be a surgeon, that's the own occupation clause, then she's going to get paid. Now, if she had any occupation clause in her contract, then the insurance company might have said, well, you can go be a professor or you can go do something else, and we're only going to pay you once you've exhausted all those options and find that there's nothing there for you. So that's a big thing to think about on the disability insurance side.
So what's the difference between a short-term and long-term disability policy?
That's a really good question. So usually a short-term disability insurance policy is going to cover you for 3 months or 6 months, or sometimes up to a year, but it's not meant to cover you for a long period of time. Usually a long-term disability is going to kick in after 3 months or 6 months and cover you for whatever period of time you've specified in the policy. Most of them are going to be to age 65 or to age 70. So the long-term covers a much broader spectrum of when you might be without your income if you become disabled. The short-term, in theory, is something that if you have a fully funded emergency fund with 3 to 6 months of your expenses, may not be necessary. Still, a lot of people like to have short-term disability because it's fairly inexpensive, and it'll take care of you if you have something pops up that doesn't last that long. One example, short-term disability, a lot of policies will cover maternity, childbirth issues. If you're out, I say issues, that I don't mean that in a bad way, but just maternity leave. If you're out because of having a child for a longer time period than your maternity period, then sometimes that short-term disability will cover some of the income that you lose. So definitely check on that because it's not in every policy, but it's in some of them.
Would you say the long-term disability policy would be more important to have if I'm a younger person, say I'm a 35-year-old and I've got a family to support and I suddenly become disabled? I'm looking at 20 years of not being able to work and no income.
I would certainly say the long-term disability is much more important because in that situation you can probably figure out how to get by for a few months if you needed to, but those next 20 years or 30 years of not having any income is going to be really difficult.
Switching gears to life insurance, what type of life insurance do I need? If I've got a young family, I'm starting off, maybe a couple of kids, and I've got maybe 15 or 16 years before they're out of the house. What type of life insurance should I be looking at?
Okay, so yeah, the important thing about life insurance is we need to have the proper amount of coverage first. So we need to make sure that in the situation you talked about that there's enough money to pay off any debt that we might have. There's enough money if you choose to pay for any education expenses that your children might have. And then also there's money left over to replace the income that you're leaving. Because if you make math easy, if you make $50,000 a year and you die 20 years before you're supposed to retire, that's $1 million of income that your family would have gotten that they're not going to get because you're not there. So the first thing is we need to make sure we have enough coverage, and if you want to do a really simple calculation, just add your debt plus education expenses that you anticipate plus whatever you'll earn between now and when you retire. That's an easy calculation. There's some more complex ones. If you Google life insurance calculator, it'll help you with that. So when we get a number of how much we need, then we can start talking about what kind of insurance. So the least expensive kind of insurance is term insurance. And term is going to cover you for a set dollar amount that we call the face amount in life insurance for a set period of time. Example is you can buy a $500,000 term policy with a 20-year term limit on it, and that means it's going to be a fixed rate of payment for that 20 years. After you get through the 20 years, it's going to go up really drastically. The benefits of term is it's very inexpensive. The drawback is once that term period is gone, then the insurance is probably going to go away.
So you would try to match your term insurance up with how long you expect to work? Is that one way to look at it?
That is a good way to think about it. The way that I think about it is if you match your term up with the expected insurance need. So if I've got a house that's on a 30-year mortgage, then think about in 30 years it's going to be gone, or in 20 years it's going to be mostly gone. If the kids are in the scenario that you used, if the kids are 10 years away from college, then if I have 20-year term, that's going to cover them cover me if I die up until they hit college, and then actually while they're through college too. So after that, college is paid for, then maybe I don't need quite as much insurance, so it's okay if the term expires.
Sometimes whole life insurance gets a bad rap. Is there ever a place for whole life in a financial plan?
There is. So whole life serves a couple of different...
and what is whole life versus term insurance?
Sure. Yeah, so whole life serves a couple of different things. It combines insurance and cash value, which we'll get into a little bit. But basically, term insurance, like I said, is pure protection, where it covers you for a set amount of dollars for a set amount of time. Whole life, just like it sounds, is designed to cover you for your entire life. So it's more expensive, and usually a good bit more expensive, but what happens is it starts when you're making payments on it, it starts building cash value. And as that cash value grows over time, then that helps offset the cost of the insurance. So in the example that we've been using with 20-year term, if you bought a whole life policy, once you get out to 20 years, it's going to have a good bit of cash value in it. So that insurance is going to continue. So in theory, the example that we use, 35-year-old, if he wants to make sure his kids get through college, he can buy term insurance to cover that. If he wants to make sure he's going to have life insurance for the rest of his life, you may want to think about whole life or something a little bit more permanent.
Very good. And life insurance is a tax-free transaction, right? So if I have $1 million policy, it pays $1 million. There's no tax consequences. Is that right?
That's right. So life insurance, in the way that it's set up, the same thing with disability insurance, go back on that too, is we pay the premium with after-tax dollars, but the benefit is tax-free. So if I'm paying, let's say my insurance is $500 a year, if I'm paying $500 a year out of my taxable income, and the benefit is $500,000 if I die, then my beneficiary is going to get $500,000 with no taxes due.
One last question. I've seen a lot of advertisements about insurance for kids. Is that something we should consider?
I would think about it. So we tell a story a lot. When I was young, one of Dad's buddies had a daughter that passed away. She was actually on a flight back in the 80s, if you guys can remember that. When flights got hijacked, it seemed like once a year or so. She was on a hijacked flight and it crashed and she died. And the fellow was an attorney, and conversation that he had with Dad was he really didn't go back to work. It was just a horrible thing to even think about. He said really didn't do anything for about a year other than just be miserable, which is understandable. So after that conversation, we've always recommended that you carry some insurance on your child, because if something does happen to them, then you're probably not going to be in the normal state of mind to go to work. So that's the first thought. The second thing that insurance on children does is it guarantees their insurability. So if Robert was to buy a policy on one of his children, and then that child becomes sick for whatever reason, gets to where they're not insurable, then there's already insurance in place on them. So that helps too. And then, past those couple options, just the kind of the burial policy that a lot of people have is probably important to think about. So you've got some money there if something does happen to them. It's not the most pleasant topic to talk about or even think about, but it does happen. Unfortunately, children die. So it's definitely something I would consider.
All right. Is there anything we've missed?
No, I would say there are a couple other kinds of insurance that I want to just mention real quick. There's a kind of insurance called universal life, which was really popular in the 80s when interest rates were really high. Universal life has a flexible premium, so you can pay different amounts for it, and I would just say be very cautious of that, because you don't want to get into a situation where you pay for insurance for 20 years and then it goes away, unless it's a term policy that is going to go away. Another one that it becomes more popular when the stock market is doing really well is variable life. I'm not a big fan of variable life. What that does is it takes the cash value in your insurance and ties it to some stock market measure. So it could be tied to the S&P 500, for example. This is my personal opinion, but I think I'd rather have my investments be investments and my insurance be insurance. So I do not like putting the two of those together. But just a couple of things to think about when you're looking at it. So I mostly would go term for coverage and whole life for long term.
Very good. All right. Well, Matt, we appreciate you being with us again.
Thank you.
Matt is a certified financial planner with Waypoint Strategic Advisors in Summerville, South Carolina. And in our next video, we're going to be talking about my favorite topic, investing. Thank you, Matt.
You're welcome.